Hey you guys, welcome to the channel. My name is Jeff.
My name is Jeff.
If you're new here, then just pull up a seat and stay a while. And if you've been here before, welcome back. Pull up a seat, stay a while. Today, we are going to learn about the stock market and finance. Now, I have been investing for a long time, and I can tell you that it's going to help you a lot if we can just lay the foundation here for your learning by breaking this down into 4 levels. Count them, 4 levels. All right, I'm going to keep it simple. The basics. What is the stock market? You got to know what this is. And the stock market is a marketplace where ownership shares of real companies, actual ownership called stocks, are bought and sold. This allows businesses to raise money because they can issue the stocks. It doesn't cost them anything. And then when people bid on them by buying stocks and placing orders, they can raise or lower the stock price. That's what happens on your brokerage when you buy it. So this is how companies raise money, and this is how investors like you and me can share in the profits or losses. Then you just need to know about the difference between stocks and bonds. Now, stocks are literally ownership of a company. When you buy stock in a company, when you enter that ticker and place an order to buy, once that executes and your order fills, you become the owner of a part of that company. Now, it might be a very little small part. You know, you're not like a big roller owning a whole chunk of Google or Amazon or Apple. Maybe you are, but you now are an owner. You have legal right to a certain slice of that pizza pie. Stocks are ownership. See that? And the other thing you need to know about finance and companies is that bonds are loans to companies, or this is something that they issue and they say, hey, if you give us some money, we will pay you back with interest. So if you want to think about it this way, a bond is really an IOU. There you go. It's an IOU where they are taking your money right now, and then they are paying you back more in the future. And this is why when you read about bonds, you'll see like AAA rated. That means that whoever you are lending money to is very unlikely to go out of business. Then the interest you get or the money you get back tends to be very little because you're taking little risk. But then some companies will offer bonds and they'll pay a lot of interest, like a high amount, but they're a little bit sketchy, a little skibbity. They might go out of business and you will be left maybe not getting your money back. So keep in mind there are different investment grades of bonds, and you need to be aware of that if that's how you choose to invest. So in all investing, this is, I think, like one of the biggest, most important thing. The higher returns that you get when you buy a stock, like a high growth momentum growth stock or a small company stock, the higher returns often come with higher risk. Not always, but usually when you invest in something that's high return and could potentially double your money in a short amount of time, for example, there's also a chance that that could go the other way and you could lose money quickly. This would be, say, comparing to something that's maybe not going to grow quite as fast. It might be even a little boring, but the chances of this big, strong, solid company going out of business are very small. I'll give you an example. Berkshire Hathaway, full disclosure, I own shares. This is a company that is solid. It has a foundation, a fortress-like balance sheet. They have more cash in the bank than I think any other company that's publicly traded. So the chances of Berkshire Hathaway going out of business anytime in the next several or 10 or 20 years are very small. Not impossible, but it's unlikely. But you may choose to invest in a company that's gone up 50% or 100% this year. And a lot of these high-tech, hype AI companies, many of them won't even be around in 5 years. So the more reward you chase after, the more risk you take on. Key financial metrics, just things to know about, are market cap. The market cap is how large a company is, and that is the total number of outstanding shares multiplied by the share price on a particular day, and that gives you the market cap of the company. And then there's earnings per share. That's how much profit the company has made during a certain period, for example, during the quarter, divided by how many shares are outstanding. So you'll hear about earnings per share. That's just how much money you received legally from the company for each share of stock that you own. And then the price to earnings ratio is just one of those ratios that are useful to some. It's not the only way to assess whether a stock might be a good investment, but PE tells you the price that you pay divided by the amount of earnings per share. So a company with a price earnings of 100 to 1 means you're paying 100 times as much as you're getting in earnings, and then a PE of, say, 15 to 1, you're only paying 15 times earnings. So some would say that the 100 to 1 is a more expensive stock compared to the one that's only 15 to 1. And free cash flow is another thing that you might like to know about. That's the money a company has left after all of their expenses are paid and they've made all of their investments. So this is like often considered the best measure of financial health. It's what's left over at the end of the day in the cash register. If you were running a grocery store or something like that, and you paid for all the groceries that you sell, and you made all the investments, you bought your cash register, or you bought a computer or a laptop, and you fixed everything that needed to be fixed in the store, the free cash that's left in the cash register, that is your free cash flow. And then dividends, it's a payment that a company makes from their profits to the shareholder. Growth companies often reinvest instead of paying out a dividend. So I'll give you an example. I own shares of Amazon. Amazon does not pay out a dividend to shareholders. They would rather keep the money within the company and reinvest it in growth. Number 3 is the types of stocks. So there are different kinds of stocks. Growth stocks, I got it written down for you right here. And these are fast-growing companies like Nvidia or Tesla or Meta, and they have high upside, but they also have higher risk. If we're talking about, for example, Magnite, MGNI, or Palantir, PLTR, or Shopify, SHOP, or Cloudflare, which is NET, when you look at them, they have a lot of upside, but they also have a lot of risk. You could invest in one of those. You could invest in Halozyme, HALO, or LSI Industries, LYTS, and those could come down a whole bunch in a hurry. They are high upside, but they have a lot of risk. Ask, what are the risks associated with this stock? What if? What could happen if? Then there are value stocks. These are often the ones that are kind of undervalued companies. The stock price is low, but they have stable profits like banks or industrial companies. These are companies that don't tend to see their stock prices go up, 30 or 40 or 50% a year. They don't tend to, but they're kind of durable and reliable. I would call them value stocks are cheap stocks, and they're usually slow growers. And then there are dividend stocks. So dividend stocks provide reliable income. They're often like utilities company or consumer staples company. Think like Coca-Cola or Procter & Gamble. And then finally, you can kind of divide stocks up by large cap versus small cap. So, for the past several years, large cap investing has been where it's at. Companies like Nvidia, Microsoft, Google have just ruled the world. And small cap stocks have not done well over the last 1 to 5 years. But sometimes things shift, and there may be times when small cap stocks come into fashion. So it's just good to know that's a nice way to sort of divide up the world of stocks. All right, so let's just talk a little bit now, number 4, about investing approaches. You can either invest in indexes, we've probably heard of, but if they're new to you, like an S&P 500 index fund or a total stock market index fund. VOO and VTI are 2 really well known. And then for people who maybe want to invest internationally, there's VXUS or VEA or even VWO. Those are all Vanguard ETFs, but they're all passively managed. So there's no one person or team going, I wonder which stocks we should buy today. No, they have a list. It's like a shopping list, and they just go out and they mechanically buy all of the different stocks that make up that index. You can think of it as a shopping list. So that's one kind of investing, is in indexes. Then there are actively managed funds. I'll give you an example. Tom Lee, who's kind of a well-known on all the videos and YouTube and stuff like that, CNBC, very smart stock guy, investor. He has an ETF called Granny Shots, GRNY. Not a promotion, I'm not sponsored. That's an actively managed fund because he and his team of analysts pick which stocks they think will do well over the next whatever the time period is, and they can add to those stocks, they can take away, they can sell stocks, they can buy new ones, and they're actively looking at the market, looking at the companies and making decisions. So that's active management. Individual stock investing, which is what I talk about a lot on this channel, which is actually as an individual, as a retail investor, also known as a small investor, we can go and buy individual stock. And then there are just two kinds of analysis, okay? There's fundamental analysis, which is essentially what I do. And that's looking at the company earnings, the financial, and the growth potential. But it's learning about like what's going on within the company. It's thinking about a stock as actually ownership of a company. When you buy a stock, it's thinking, okay, if I buy shares of Quanta Services, okay, the ticker there is PWR, what does this company do? Who's the CEO? How much money do they look to make in the next quarter? Is this company going to be a better company in 5 years than it is today? Asking these qualitative questions. That's a fundamental analysis, okay? Looking at actually how the business is doing. And this is separate, this is different from technical analysis. A lot of people do this. I'm sure a lot of people watching this video are into technical analysis. So this is studying the stock price, charts, patterns, trading volume. They're going on to Thinkorswim, like the platform where they've got the multiple computer monitors and they're looking at all the different charts and patterns and technicals and doing analysis with RSIs and momentum indicators and all that stuff. So that's like a whole different world. Neither, I would say, are right or wrong. I think some really good fundamental investors do pay attention to technicals. There's nothing wrong with that. And I just think they're different, and you should know that those exist. Finally, the last thing I think you should know as far as investing approaches is the behavioral approach. And behavioral approach is using psychology, essentially. Psychology plays a huge role. Fear, greed, and herd mentality all drive market swings. And I think, that's maybe a lesser known approach to investing is focusing on behavior. But I think that the psychology of investors and psychology of markets is an underappreciated but very powerful force in markets. I know as I have learned about investing and become better, I've paid attention to my own behavior and also my own intuition, because I think sometimes when you really understand a business, when you're either a customer or you work at a company or you have a lot of experience with their products, you start to get a feeling about this company. And it could be a feeling of, I don't like it and I don't trust it and I would never want to own it. Or you can feel like, oh my gosh, this is an amazing company. Like, I love this product, or I love working here, or I love what they're doing with their technology and where I see it going in the future. So that is also a feeling or an intuition that you can act upon. And this is just something that I am learning about and practicing. I'm putting it into play in my own investing, and I just find it fascinating to learn how our minds work and how we can use our own brains and our thinking, but also tap into something maybe even more powerful than the conscious cognitive brain, but tap into our intuitive feelings when we invest. So that's kind of my whole everything, soup to nuts, fear and greed, risk and reward, stocks and bonds. I think everything that you really need to know. Some people spend their whole lives focused on just one little part. But I wanted to give you kind of an overview, something to think about, because there is so much information out there, and every day it's easier to just get overwhelmed. I know when I started investing, I didn't even know what a stock was. I just knew it was something you could buy and you could hope that it went up. But I didn't know that, wow, when you buy a stock, you actually become an owner of that company. I know it seems like a very simple thing now. You probably know this already and it's like really basic, but I think that sometimes just understanding that and really like letting it sink in, that when you go and you buy 10 shares of this company, now you benefit from all the decisions that are made from the CEO of the company to all the executives and the board members and the people working in the stores. They're all working for you. They are all working to help that company make as much money as they can to enhance that company's profits. And all of that flows through to you as an investor, because you become the person at the top of the food chain. When you are the investor, you are the owner of the business, and you have as much right to that business through each share that you own as the CEO or any other investor. A share is a share, and nobody has more power per share than you. So it's a great thing to know, and I hope that you found this useful. And I also hope that if you liked it, you'll just tell me, just put a note, because I don't usually do kind of overview videos like this covering the basics, the meat and potatoes of investing. But if you like this kind of stuff, let me know. And if you want more ideas and information about stock investing, subscribe to the channel. You know the little button, just boop, and notification bell, and you know the whole deal. But that way you will become part of the Animal Donut family. Check it out. Animal Donut Tribe. And when I make a new video and upload it, it'll just go, hey, there's a new video from Animal Donut. He wants to say hello to you and see how you're doing. I'm just checking in on you, and I want to make sure that you are having a fantastic day. So thank you for being here, and I will see you in the next video.